Welcome to We Build Great Apartment Communities, the only show dedicated to the process and strategies for transforming apartment buildings to thriving communities. I am your host, John Brackett, and welcome to the show. All right, folks, welcome to another amazing episode of We Build Great Apartment Communities, the place where you come to learn how to take apartment buildings and turn them into amazing communities. So another great guest today, Yonah Weiss, as someone who I think you're going to find just not only a great professional, but also a great strategist in maximizing benefit to operators, owners, investors. So Yonah, welcome to the show. How are you, buddy?
Thank you so much, John. It's my pleasure to be joining you today.
It's my pleasure to have you. So I'm going to introduce you to our audience, share with them your bio so they have a better feel for who you are as a professional. So Yonah is considered a powerhouse with property owner tax savings. So as business director of Madison SPECS, a national cost segregation leader, he has assisted clients in saving tens of millions of dollars on taxes through cost segregation. So he has a background in teaching and a passion for real estate and helping others. He's a real estate investor himself, and he's also the host of the new podcast, Wise Advice. Okay, so really excited to have this conversation. I think the timing is great to get into the discussion of cost segregation. So tell us a little bit about your background and how did you get into that space to begin with? What was the transition that ultimately led you to building a career at helping people save money in taxes using this strategy?
Yeah, I mean, I think it's always a good time to talk about cost segregation, but it's interesting how I fell upon this. And I really say fell upon it because, it wasn't like, oh, when you grow up, you want to be a cost segregation expert, right? It wasn't anything of the sort. I mean, really, I didn't even know much about real estate about 5 years ago whatsoever. So it's kind of new to me in general. I mean, relatively speaking, I was a teacher for about 15 years, and that was really my passion has always been in teaching. I even did that before I had a job as it, just, in school, in high school and whatnot. I was always working with kids and working with students, tutoring and whatnot. But, at a certain point in time, it came, you need to find something a little more to do, something a little better, maybe financially. And real estate was something that just came to me like, almost like a lightning bolt. Oh, this is a great idea. I had a bunch of friends doing it, and I just reached out to people. I was like, I'm looking for something a little different than just the teaching. And it just kept coming up over and over, different things, real estate. So first I got into commercial mortgages. I started with a partner friend of mine who was doing it for many years and just showing me the ropes of commercial real estate through that avenue. Became a residential broker for a little while. Again, just getting my feet wet. Right. I learned, how to do that, how to find deals, how to find buyers, et cetera. Did a few fix and flips. And then, one thing led to another. I really found this company, Madison Commercial Real Estate Services, the company I work for, do a bunch of different things. But one of the things they do is cost segregation. And I was just fascinated by this as soon as I learned about it, because essentially all you're doing is just helping people all day long, saving taxes.
Sure.
And to me, it was like, oh, this is a great idea. Everyone should be doing this, right? Everyone knows about this. And what I found is that there are so few people that are actually taking advantage of it. And, the more I dug kind of into that, it was like, well, it's mainly because people just don't know about it. And I was like, okay, I can use my teaching resources, my background, and with this business development of this company to try to do whatever I can to get the word out and start showing people the power of this method, how you don't have to pay taxes in a legal way if you own real estate. And really that's what it comes down to. So, I'm a very quick learner, and because of my background in teaching, I have thank God, a great ability to take these concepts and just teach them and be able to give them over in a very simplified way. So that's kind of how I got my feet wet in all this, really. It wasn't, no background in teaching, in real estate, accounting. We have a huge team, and really that's really, what it comes down to. I could not do what I do if I did not have this awesome team of accountants and engineers, and experts behind me.
Hey, I really appreciate you sharing that background. One of the things that stood out, well, there are a lot of things, but one of the key things that stood out in your summary there was your teaching background, right? And some of the learnings that you've been able to use to map that over into what you do now. And of course, it sounds like one of the greatest skill sets is your ability to communicate a message, taking complex concepts, simplifying that, and then being able to communicate that across to people so that they understand it, right? And why is that so important, right, in the world that you operate in, especially around tax? Why do you think that's been such an important skill set for you? And obviously it's helped drive your success, but can you talk about that a little bit? And here's why I asked the question, right? Because we have a couple different listeners out there, right? We have those folks that are looking to get into the business, right? That are reaching out, wanting to learn information. So they're information gatherers. Then we have the seasoned operators, right? Investor operators that have been around for quite some time, right? Own multiple projects. And then of course we have the passive investors. Okay. And that's really our audience. So for the different groups, the idea is always to find things that we can do that can map over to make us more successful, right? In your case, teaching has been a huge benefit, and you've been really good at taking that and mapping that over to what you're doing now. So can you talk about that a little bit? Because man, I find that fascinating.
Sure. It's interesting, John. I think when people hear taxes, for the most part, I think the vast majority of people, their brains kind of shut off, right? They're like, I think it's just like, no, taxes, it's too complicated, it's too much. I have an accountant, that's why I pay them, so I don't have to think about this. And the truth of the matter is that's amazing. When you think about that, you start talking about taxes and people's just brains shut off, or they're like, I don't know about that, I don't need to know about that. And I don't know what it is about that, but it's fascinating to me. And so what I found is that when you simplify things and you just start with kind of the end result, right? Which is in real estate, right? Everyone talks about there's the great, appreciation and equity and wealth building, and everyone's like, yeah, right? And then everyone says, well, tax benefits, right? Real estate comes with all these tax benefits. Well, guess what? Those tax benefits are basically cost segregation. I mean, depreciation, which cost segregation is just an advanced form of depreciation. That's all it is. So it really behooves you and everyone to just understand the basic concepts of it, to then empower you to make sure that you're taking advantage of these things. Because believe it or not, even, most accountants out there don't even know about this, which is incredible to me. So that's kind of what I found. And so when I speak to, it doesn't matter who it is, whether it's passive investors, whether it's operators, whether it's new people, it's important to just learn. And I think that's why everyone's listening to this podcast, right? Everyone listens to these podcasts in order to learn and kind of open their minds to new information that they didn't know until now, or maybe they did know, but want to learn a little bit more, a little bit deeper about.
Okay, cool. So let's now invite our audience into the conversation of strategy, right? Because now we've given everybody a great background. We understand what your superhuman power is, which is teaching, the ability to take complex concepts and simplify them so we can understand them, right? So now let's do that. Let's use some practical examples and articulate the benefit of cost segregation, maybe using a recent example, okay? So do you have a recent example, maybe in this case, an apartment building, because that's what the show predominantly covers. Can you talk through a recent example that you helped someone, or a case study rather, right? Recent example, we can use that so you can help explain the benefit of cost segregation and then what that looks like so that our audience can have a better understanding, and then we'll unpack that as we go further.
Absolutely. Yeah, I think the first step is to understand what really cost segregation is, or maybe we can pack that out, afterwards. But
no, let's do it. However you want to take this forward, I'm going to let you lead, right?
So simply, like I said before, it's an advanced form of depreciation. Okay. But depreciation sounds like a weird concept, right? The concept things go down in value as time goes on. But we have to understand from a tax perspective, from income tax benefit, depreciation is a tax deduction based on the concept that things go down in value as time goes on. But the amazing thing is when you buy a property, even this property was built in 1927, you get to start your depreciation schedule from the day you buy it, which means you have 27 and a half years to take the entire value of the property according to how much you paid for it and write that off as an income tax write-off. Okay, so literally, you buy $1 million apartment building, you can now write off $1 million from your income taxes as a tax write-off over this 27-year period, right?
Right.
That's depreciation. But it gets crazier when we bring in what cost segregation is that there are certain aspects of the property, certain components of the property that depreciate faster than that 27-year schedule. So you can actually take a large sum, okay, a lump sum of that, depreciation deductions that you should be spreading out over a 27-year period. You can actually accelerate that and take a large portion of that in the first year or over first 5 years of ownership. So essentially, we're like multiplying our tax deductions in the early years of ownership by 2, 3, 5 times.
Okay, great. So let me unpack that a little bit, okay?
Yeah, okay.
So if I heard you correctly, and let me unpack this a little bit.
Mm-hmm.
So every tangible asset, okay, has an expected useful life. All right? And inside of that expected useful life, we have the ability legally through IRS scheduling to deduct what that expected useful life is. Now there's straight line depreciation. In this case with residential real estate, we can straight line that or divide, okay, the benefit of that depreciation over the course of 27 and a half years, right? Correct. So let's use an example. Let's say I purchase a $10 million property, in this case, a multifamily property. And I call you up, I say, Yonah, I have an opportunity here. I just purchased this building. I want to look at accelerating the depreciation. Historically, I can do this over a 27 and a half year period. So 27 and a half, divide that by $10 million. That's roughly $500,000 per year for a total of 27 and a half years roughly, okay? To keep the numbers whole. Now, what you're saying, John, I can help you now accelerate that tax benefit, which is a non-cash expense, okay? I can help you accelerate that so that you're not having to stretch that over 27 and a half years. Rather, we can bring that benefit forward much quicker, correct?
Yes.
Okay, perfect. So now we have this example, right? We have this example, so now it's becoming real. So can you talk a little bit about the difference between accelerated depreciation? So in accounting, right, we have makers, okay? And in the world that we live in, which is the world of real estate, we have cost segregation. So can you talk about the distinction between the two? Because our audience now understands what straight line depreciation is, right, over a 27 and a half year period. We talked a little bit about the traditional accelerated depreciation schedules that the IRS provides, but then you're accelerating that, but with a different approach based on useful life, right? So can you talk about the distinctions a little bit?
Absolutely, sure. And just to clarify, this is not some like weird, strategy. All of this is directly from the IRS. So actually the IRS created these rules. Just want to clarify that it's just a different way of structuring it, which, believe it or not, according to the tax code, is the proper way to depreciate your property in this way. It's not required, which is a discussion in and of itself.
Right.
But simply speaking, yeah, the useful life concept is that there are certain things, certain components of your building that have a shorter useful life. And simply, we're taking advantage of those shorter useful lives to take the tax deductions of that faster. And really, like you mentioned, you're taking, a certain amount, like $300,000 or $500,000, whatever it is, every single year. That's a great tax deduction off the bat. I mean, depreciation is huge. It means you're reducing your taxable income. On a $10 million building, maybe you have $1 million of net operating income. If you can reduce that in half or by a third, automatically, that's awesome, right? But there's a way to actually cut that off entirely. So let's break it down. Simply put, there's 4 categories how a building is broken down. Okay, there's the land, which actually doesn't depreciate. So whenever you buy a property, the first thing you have to do, first of all, is take off a certain amount for land allocation, land value, which does not depreciate. Then the remaining amount, that's the amount that you can now write off. It's called depreciation basis. Okay, so your basis, maybe that's 10%, 15, 20%. It's usually not more, except maybe in certain places like California, where the land is very expensive. It can literally be crazy, like 50, 60%, which is It's unheard of, but it does exist. So you have to be aware of that. Regardless, that's one category. It doesn't depreciate. The second category is the building structure.
Right.
Okay, the main structure of the building, and really that's the only thing that has a useful life of 27 and a half years, or commercial, like we said, is different, 39 years. But let's stick to apartment buildings we're talking about, because that's considered residential for tax purposes. Then there's two other things. Now, why I say, and I mentioned at the beginning, this is really just a borrowed concept, because a building doesn't really have a useful life, right? Your brick wall and your roof, maybe the roof does, but the floor and the foundations and the windows and doors doesn't really have a useful life of 27 and a half years, because that schedule starts the day you buy it. Again, you may have bought a building that was built in 1930, and now you bought it, you get to start over your depreciation schedule from 27 and a half years based on your purchase price. You sell it 5 years from now, the new buyer, based on his purchase price, can now take that as a tax write-off for the next 27 and a half years. So he starts over. So that's why it's not intrinsic to the building as the quote unquote useful life. However, the two other categories are, it makes more sense that they have a faster useful life. So the other two categories are what's called land improvements, and that depreciates on a 15-year schedule. So basically anything outside of a property, which can include landscaping, pavement, if you have a parking lot, any type of asphalt or curbing, fencing, storm drains, et cetera, anything outside the building, there's a lot, playground equipment, et cetera. All that depreciates. The value of those things depreciate on a 15-year schedule, which means if we can identify how much money is in that part of the property, then you can now take that value as a tax write-off over a 15-year schedule, okay, over 15 years, as opposed to lumping it together in 27. So those are three categories. We got the land, we got the building structure, we have the land improvements, okay, on a 15-year schedule, and the final category is what's called personal property or tangible property, and that depreciates on a 5-year schedule. What that means is that, and there are a lot of things that the IRS determines called personal property, even though you wouldn't think about it as personal property. Basically anything that's not structural to the building. So, you know, cut out the walls, the roof, cut out the doors and the windows, main electric, main plumbing systems. Those are all structural components, but anything else basically is personal property, which means the wall coverings, okay, carpeting, appliances, furniture, fixtures, all the light fixtures and the sockets and all that kind of stuff. All of that, when you start adding all that stuff up, like, you know, that all has value to it. And there's a lot more things I didn't mention, but all of those has value. When an engineer, really, this is what cost segregation is about. It's an engineering technique that engineers who are, you know, very trained in construction engineering and know the tax code to know what all those components are, how much value is placed in each of those, and now take that value, and now we can take that as a tax write-off over a 5-year schedule, over a 15-year schedule. Okay. And basically splitting up the building.
Okay, beautiful, beautiful. And I love how you summarize that, right? So I'm gonna just repeat what you said, okay, for our audience. So essentially, when you're looking at a building and you're looking to apply the strategy of cost segregation, you're assessing this from 4 different perspectives, right? And ultimately figuring out the best way to maximize the benefit of that building. But the first thing is land, okay? Yeah. And of course we can't depreciate land, right? Because land is not improved, it's raw. It's the raw product or the raw material through which we build on and we monetize into an apartment building or whatever the product is, right? So you're netting out the value of the land. So here's a question, okay? So land, then you talk about improvements, and then of course building. Now the improvements, you're saying you can depreciate that over a 15-year period, right? So if the building is 27 years, you can accelerate that by 15 years, building 27 and a half years. And then lastly, personal property, or the term that we use in the industry is FF&E, furniture, fixtures, and equipment. Okay, and that's a really big one because you can now shorten that to 5 years because in theory, that equipment it just takes more wear and tear, right? And so that's a really an important one. We're gonna talk about that a little bit more, but here's the question. So in different states, land is valued very differently, right? Even in different submarkets, in different markets, different states, different submarkets for that matter, land has a different value. Some land more valuable than others. So, you know, without getting too complicated, okay, with say the residual value of land, are you using assessor value to determine land value, or are you coming up with your own computation to be able to net out the value of the land? Because obviously the higher the value of the improvements relative to the land cost, the greater the opportunity to accelerate depreciation, right? There's a greater benefit there. So
Absolutely.
Can you talk a little bit about how you approach that? And I know there's a formula, but in this case, a little bit different because we're not using a specific example, but just so that our audience can kind of see how some of this stuff works. Can you talk about that a little bit, Yonah?
Sure. So the land value, and it's a great point. It's like you said, it's totally relative to, number one, the location, and number two, the type and size of property, right? If you have a little, 2,000 square foot, building on a 10 acre property. So it makes sense that the property, actually the land may have more relative value than if it was a 3,000 square foot lot, right? Sure. So one thing that we do, and we're not land appraisers, so that's the one thing that is a difficult task, to figure out what the land value is. And typically, and what's even more difficult is that the IRS does not even give guidance onto, or give any set rules, I should say, onto what kind of method you can use to determine the land value in any given place, which makes it even more confusing. Because you would think, everything else, all the other parts of the property have very, very set determined rules, right? 27 and a half year, right? All this stuff, the value is there. Right. Broken down into tiny components. So there are basically 3 different ways to figure out the land value. And any one of them can work. Okay. Number one is by having a third party appraisal. And a lot of times that's what people will have already going into this. And they'll tell you what the difference between the land value, the building value is. The second way is to use, the county assessor. The assessor is going to give you what they consider the land value, and they're going to base your property taxes on what they consider the land value versus the improvement value. Sure. The third way is to just use comps in the area where land is being sold. Okay, so if land is being sold for a certain amount per square foot, then you can kind of use that to determine based on how much your land would be worth besides for the building itself. So those are a few different ways, and that's, unfortunately, it's not as, like I said, clear cut. We find, and because it's not clear cut, and because there are no set rules to it, that actually makes it better in a way, because the IRS is very not going to come out and tell you you're wrong. Right off the bat. If you have any way to determine that you've come up with that number, then you're basically in the clear, which, is great because it gives you a lot more leeway. So I've seen, the national, and sometimes people just like to use an average. They'll say, okay, I don't know about my particular market, but, in general, in the state or in the nation, or the average is such and such, 15% or something like that. So like I said, there's a lot of different ways to go about it.
Okay, so now let's make this benefit tangible through our example. Okay, so we talked about a $10 million building, then we talked about a 27.5 straight line depreciation schedule, right? Which would be the typical way to depreciate a residential building. So let's use the example that we talked about. In that case, it's a $500,000. You brought up an NOI number of $1 million. So in this case, $1 million minus $500,000, which is great, right? Leaves now a net cash flow value of $500,000, right? Right. So if we didn't have the depreciation there, we would be paying $500,000 more, right? We would be, our income would increase by $500,000 more, right? So in theory, we'd be paying a lot more tax. Right. With depreciation, we reduced our income by, in this case, $500,000, right? So we're paying less, $500,000, not $500,000 less in taxes, but we're paying on $500,000 less. Okay. Right. Now with the accelerated depreciation example that you're giving us, okay, so now we can take that $500,000. Okay, and I'm going to use just a general concept here. We can accelerate that forward times 5. right? So now that's $2.5 million. Okay, so the benefit now, instead of it being $500,000 a year, in theory, now it's, $2 million tax deduct, a $2 million depreciation benefit, right? Okay.
Yeah.
So, okay, now beautiful, right? So now we're gonna move this forward a little bit. So now our audience, they can follow along with us. Now that the benefit starts becoming real. So talk about when you're approaching an owner, an operator, Yonah, and you start making this assessment. What is the approach, right? Like, what does that conversation look like? What are you first looking at? We talked a little bit about the strategy and how you do that, and that inside of a building, the building has different components with different values, right? And so you, as a professional, you go in there and you figure out what those values are, and you, of course, guide the owner around that. So can you talk a little bit about, when you're meeting with me in person, what does that process look like?
So it's pretty simple, pretty straightforward. The first thing we always do is we run a free assessment. So if we're on a free analysis, we just take a few, without ever going to the property, we take a few data points, and we've done over 15,000 of these studies across the country. So we know pretty much when we pull in a few data points, like the square footage of the building, the unit count, the breakdown of the unit layouts, et cetera, we know pretty much what, based on the purchase price and the year built, et cetera, we'll know basically what your tax benefit is going to be. So the first thing we always do is run a free estimate. And so that gives you a pretty clear understanding of breaking down and seeing, okay, if I did straight line depreciation, I'd be getting, about a 2-3% deduction of my purchase price every single year. If I did cost segregation in the first 5 years, I can be taking 20-30% of that depreciation in those first 5 years, or in the first year with bonus depreciation, which we'll get to in a second. So that's really the first and foremost step that we do, and that's pretty straightforward. Once we end up going forward with the study, we'll send an engineer to the property, and that's really where the bulk of this happens, is taking a full, like appraisal, like assessment of every tiny detail, measuring and pictures of everything in the property, because we have to determine all that personal property, all those fixtures and furniture and everything like that, how much is in there, cabinets, countertops, all those things, they're actually on a 5-year schedule. What that is, create this very detailed report, which can be like 100 pages long. And then in that report produces a 1-page new depreciation schedule. And that 1 page is really all you need for your taxes.
And so that 1 page then goes to my CPA, or our CPA, right? And of course, now we have the supporting documentation to be able to validate what those values are being reported as, right? With the report that you create. Okay, beautiful. I really love that. So I like the explanation. So one of the things that I heard you say is that one of the very first things you do is you provide a free assessment where you're comparing the straight line approach to any proposed benefit using the acceleration method, or in this case, cost segregation, right? And if there's a substantial benefit to cost segregation, in that case, the proposal then is to move forward, and then you start, working on that based on what that perceived benefit or that proposed benefit is, correct?
Right, exactly. Okay. And when I say proposed benefit, I would just like to clarify that it's totally conservative, meaning we know already ahead of time what the minimum benefit's going to be, and that's what we'll see. It's not like, well, what if you come back and it's really not like that? It's 99.9% of the time, based on the facts that we know, by the property, we make that assessment, and it's pretty straightforward.
Okay, so here's something that's very common. I hear this in the industry quite a bit, and frankly, I used to make this judgment as well, which was I've learned over the years was incorrect, and that is that a brand new building has much greater depreciation value than, say, an older building. Okay, now in theory, the newer building should, right? In theory, there's a lot more to depreciate. But I've learned over the years that may not always be the case, because that older building could have been improved, right? There could have been a lot of things that have gone into the older building. So can you talk a little bit about that? A newly built building, say let's try to compare apples to apples, except the age of the building, right? So we
Right.
have a newly built building, 100-unit apartment building, same state, same submarket, and then an older building, say it's 15 years older, same
Right.
thing, 100-unit apartment building, construction in theory relatively the same, maybe not so much because one is 15 years older, but in
Right.
theory relatively the same, right? So can you talk a little bit about that, and then maybe unpack some of the misnomers around the fact that a newly built building may have greater depreciation value over an old, or vice versa?
It's a great question. And so this really gets into kind of the real nuts and bolts of how cost segregation works. And it's not, I simplify it as much as possible to understand that we're breaking down from a property into 4 different categories.
Right.
But really, when the engineer's coming in, when you're talking about new construction, we're looking at the invoices and we're looking at the values that were actually spent on building this. Okay.
Cost of construction.
Exactly. And so you cannot come up with any other numbers except for those numbers that were provided. If you spent $50,000 paving a parking lot, that's how much that $50,000 is now depreciated on a 15-year schedule. However, when it comes to cost segregation, what we're doing is we're actually basically reverse engineering the property, which is pretty incredible when you think about it. And in that, there are a lot of different rules that go into this. One of those things is that you actually have to use, historical multiplier. There's some truth to be told that a newer property may have a slightly bit, and I'm talking like a fraction of a percent of more value than an older property. But there are many times when an older property can actually have more value from cost segregation perspective than a brand new property. And one of those reasons is because we're looking at reconstructing this building. Okay, so we're looking at actually reverse engineering it and saying, well, if I were to build it today, how much would it cost me to build? And now breaking down those parts, the asphalt, how much is the square footage, how much does that cost? We can actually apply a larger value to that, which can be more beneficial.
Got it. What's really interesting is when you said this, I started thinking about this. And so you're right. Say I build a $10 million 100-unit apartment building. My cost basis is really what you're looking at to start your assessment, right? Mm-hmm. Now, on the same token, though, say I purchase a building, okay, in another state with a higher value, say a Texas versus a downtown LA, okay, or Texas versus an LA, right, downtown LA,
right.
100-unit apartment buildings. In theory, LA should be more expensive, right? And say that's a 15-year apartment building or 15 years old, but my basis really starts at my purchase price. So that's really the reset there. And so when you started talking about that, it made me think that, yeah, actually right. And so at that point, a lot of that is going to start coming down to how you're valuing the improvements, right? And how you can net out land to start that assessment.
Right.
Very, very fascinating. I really love this topic. I think this is a great topic, especially as you start to build and amass more and more real estate, right? And when you're working with partners. Now, is there one instance where this could be more advantageous than another when you're an owner operator, say you own 100% of the building, versus when you're in a project with multiple investors, right? And of course you have multiple A1s. What are your experiences with that?
Well, yeah, I mean, the depreciation is an expense. Okay, so that's going to be allocated on your K1s according to your percentage of ownership. So if just like your income is going to be allocated according to however you're breaking down that income amount. So essentially, if you make 100% of income, you get 100% of those deductions. It's obviously going to be more advantageous to you, but it's going to be percentage based. Okay, so if you're an investor, a passive investor, the great thing about passively investing in this is that you get to benefit from it. And so the rental income, okay, coming after all expenses, is usually going to be tax-free income, okay, at least during the first 5 years of ownership, for sure. So that's really where cost segregation comes in, that it's so beneficial, is that even if you're just passively investing, where else can you find a return on investment that is going to be tax-free. Okay, you're always going to have to pay taxes, but here you're going to have actually many times a passive loss, which means you're going to have more deductions than you even have income.
Sure.
So that's going to be translated across the board according to how much you own of that investment.
I love that, man. Thank you so much for sharing that tip. Great tip. Yonah Weiss, you've been a tremendous guest. I really appreciate you being on and sharing your insights. And I especially love how you broke everything down, right? Especially with the 4 methods, and then starting with land, netting out land, then moving on to improvements with 15 years, and then the building over 27 and a half years. And then lastly, personal property, being able to depreciate that value down, based on a 5-year schedule. So I think that was a great way to start into that conversation. And then you finish with explaining to our audience how they benefit, especially if they're a passive investor, and how depreciation can effectively offset the majority, if not all, of that income, right, from rents, to create even a greater benefit as we're able to now save more money, right? I think one of your quotes is, it's not how much you make, it's how much you save.
Right, exactly.
So I love that, because it's really, really true. Well, Yonah, you've been a great guest, and I appreciate your time very much. Thank you so much for being on the show. How do people get in touch with you if they want to learn a little bit more about what you do, or they have a property that they want to reach out to you on and learn a little bit more about your services? What would be the best way for them to do so?
You can find me on LinkedIn. That's a great place. I'm very active there. Or you can go to yonaHweiss.com. Find out a lot more about what we're doing there. You can also submit a property for a free analysis through there. Again, my company, Madison SPECS, the largest national company. You can check out madisonspecs.com as well. And very happy to. And if you do find me on LinkedIn, which I said I'm very active on there, make sure to mention that you listened, that you found me on this podcast, and have a little context of how you're reaching out. So
awesome. Thank you so much, buddy. I wish you, an amazing future success, and keep doing what you're doing. I can't wait for the next time we have this conversation, when you have done, double the volume that you're doing now, right? Because that means your experiences are going to be doubled, and now you can come back and give us even greater insights. So Thanks again. Appreciate your time, and I wish you continued success.
Thank you. Thank you, John.
You're welcome. Clarity of purpose creates our greatest competitive advantage. When we transform apartment buildings to thriving communities, we improve how people live and create assets with high profit margins. Don't forget to subscribe, like, and share this up with a friend. I'm John Brackett, bringing you things you can implement right away.